2 reasons the stock market is not a bear, but rather a bull over the next month. Let's get into it. Here are 2 reasons, 2 of, I guess, the most substantial reasons that I've conceptualized and thought of as I've been reading and doing some research and some analysis for why the stock market could go to the moon. Now, is the stock market actually going to go to the moon in December? No one has any clue. The S&P just passed 400 as I'm recording this right now on November 23rd. And, psychologically, that's pretty cool. You're on the S&P at 400, 401. Remember, we were at lows of 348 on the S&P back in just a couple of weeks ago. I believe it was back in October, and October 13th. So we're up 15% from those lows. Could the market rally in December? Here's 2 reasons I think it could, but there's also obviously a chance that it falls and it crashes and burns all in our face. Here's potentially 2 reasons why it doesn't. First is the Santa Claus rally. So the first documented pattern in 1972 happened, written in the Stock Traders Almanac, that the S&P 500 had gained an average of 1.5% during the 7-day period from 1950 to 1971. The pattern has held true since 1950, with the broad market index increasing an average of 1.3%. Additionally, the market has gained during those 34 days in the previous 45 years, or more than 75% of the time. So some other couple stats that are interesting here. In both 2008, the Great Financial Recession, and 2018, the Santa Claus rally successfully predicted bull markets for the coming year. In 2009, the broad market index gained 23%. In 2019, it rose 29% because we had that Santa Claus rally. However, it's not always an accurate predictor of gains the next year. In 2021, the S&P 500 gained 1.4% in the 7-day period right before we entered into the new year, but it peaked on Jan 3rd, 478 on the S&P, and then we entered a bear market by June. Since 1994, stocks have risen 23 times during the Santa Claus rally period. The following year has been positive for the S&P 500, 18 out of those 23 times. One of the 6 times that stocks have fallen during the Santa Claus rally period, the market has fallen in 4 of the following years, which is incredibly important to understand. That means 23 times, or since 1994, stocks have gone 23 times up during the S&P rally, or during the Santa Claus rally. The following year, if we had that rally, we had 18 out of those 23 times, boom, the entire market went up. In 2019, 29%, and in 2009, 23%. However, if we do not have that S&P rally, if we do not have that Santa Claus rally, then the market goes down 4 of the following years in which we did not get that gain of 1.5%. So that is another argument, another reason for why we might have a Santa Claus rally. Historically, we have had that average of 1.3 to 1.5% gain around this time in December. And if that happens again, then that is likely going to lead to another form of the market potentially going up, or the market potentially collapsing, because again, 2021 wasn't an accurate predictor of that, but 2021 was also an anomaly because of a variety of reasons, many of that being a lot of more pumped up liquidity in the system that we had to get out and a lot of quantitative easing. So that's one simple argument, right? If you just look at the pure basic historiography of that, I don't even know if that's the correct word, but the history shows if we get a little bit of a rally, and historically we end up getting a rally 75% of the time, even if it's 1.3 to 1.5% during that Santa Claus time in the period of December, we end up having a little bit more of a bull market. So if stocks right now are at 400 on the S&P and a lot of stocks are oversold, there is an argument to be made that the indices are holding up well, even though the big names are down. So for example, Tesla just hit its 52-week low at 166 yesterday. Now it's at 179, recovered about 10%. So you've got something like a Tesla that is already trading significantly lower than it was at the beginning of the year. You've got Meta that's collapsed. You've got Google, Amazon. I mean, don't even get me into all the SPACs and the smaller growth names like DraftKings and all of these stocks have collapsed close to 70 to 80% year to date in 2022. It's bad. Or from November 30th, 2021, when we called the top. To argue that there is a lower edge for them to go, it's not that stocks can't go lower, it's just that some level, are they going to be down 99%, especially companies that are putting up $90 billion in 90 days, that are doing $70 billion in 90 days, $128 billion in 90 days. This is Apple, Google, Amazon. I mean, these are companies that are producing real forms of revenue. These are real products. These are things that we actually use. To imagine that the S&P would collapse 15% in the next month, up at $400, all the way down to lows or new lows at 348. Again, it's possible, but if we look at individual stocks that are massively down. One would argue oversold from their not even all-time highs, but from their 52-week highs. And then for the market to follow that leg down, even though those stocks are already down. Remember, as the market falls down, for example, the Apple is 7% of the S&P. So if the S&P is trending down and then Apple is trending down, it's just catapulting effect that pushes everything down. Apple is already decently down. It already touched, 130, 135. Now it's sitting at 150. For it to go even lower and for the market to even go lower as a result of that, maybe. But if the Santa Claus rally is correct, that probably wouldn't happen. The second reason that I believe that the market could rally in December is 3 letters: C, P, and I. So that's cool. And I. CPI. Look, CPI came out 7.7% in December. Not a bad CPI print, or sorry, in November. Not a bad CPI print, especially because we were going down from 8.3%. If we get a shocker and CPI goes up 7.9%, 7.8%, or it's flat, 7.7%, then it's going to be really tough in December because that means the Fed is not able to tackle inflation. The Fed is in no way going to pivot, and a pivot would mean they just stop raising rates. Of 75 to 50 is still a little bit aggressive, so maybe we get to 50 if inflation starts to go down, but there's no way inflation goes down so substantially that the Fed completely stops, and it definitely won't happen if CPI goes up. So if CPI somehow happens to go down, and let's not even say significantly down. Let's say 7.7 to 7.3, 7.4, even 7.5. That is showing down. It's deaccelerating. At least it's going down. The Fed's probably not going to pivot. The Fed's not going to stop raising rates. And the Fed, even at a 7.3, 7.4, I don't think the Fed is going to go to 50 basis points. They're probably going to keep it 75 basis points. We'll get a little bit more information as the Fed minutes are released. But, I mean, if CPI comes in nicely, there is no reason for December to be a horrible month because the market is going to be very happy that inflation is going down and that's signaling to the Fed that, hey, maybe we don't have to raise interest rates to 4.6% or 6% as the nominal. Maybe we can actually find a way to get inflation down. Maybe Cathie Wood and her argument about deflation was not total BS and there's actually a coming wave of commodities that have peaked and different technologies that are going to reaccelerate our economy to deflate, for inflation to deflate, which would accelerate the economy, more people getting into jobs, more people getting to work. Maybe we actually need more stimulus. Maybe that could potentially be the case. So the only reason I think this is logical is because we had that beautiful CPI print in November. Germany's producer price index went down 4.2%. It was expected to rise for 0.9%. Remember, the PPI influences the CPI because the PPI is how much producers are willing to pay for the raw materials and their products, which then influences the cost they put onto consumers because if it costs them more to make something, they're going to cost you more to buy something. So if the PPI is going down, the CPI theoretically should follow. Now, Germany still has bad inflation at 5%, and in the UK has horrible inflation right now. It's not, a global trend that everything's going down, but if the United States can somehow find a way to get it under control, which, by the way, it's going to be hard because we've got oil problems. We're not releasing strategic oils anymore from the oil reserve. We've got the geopolitical crisis, Ukraine and Russia still happening. So it's not like this is going to be the easiest thing in the world, but if somehow December 13th, CPI comes in lower, and dare I say significantly lower, and the Santa Claus rally is starting to trend into effect, and the S&P starts to break over some psychological barriers of 400 or 404. Let's actually go to it, by the way, right now. We're at 401.98. Imagine you're at 405, 406, 407, and all that data starts to line up. There is a world in which the market potentially could rally and that we would have a bull market going into 2023. But then the million-dollar question, the multi-billion-dollar question, is if in 2023, this actual recession that's supposed to be coming is going to come. And we'll have a lot more data to be able to analyze that. But those are my 2 reasons. The first being the historical precedent for the Santa Claus rally and what that means. The second being CPI. And the third that I forgot to mention right here, it's a small little tidbit fact. Every year since 1958 on the S&P 500, after the midterm election year, which is 2020, which the last time we had it was 2020 and then 2018, the market rallies an average of 15%. So let's say the S&P closes at 400, which is down 10% from 478. We would go up 5% or 15%, which means we would go up 5% net because you would get rid of that 10%. And 2023 would be up 5% for the year, which, it's like that's happened historically, an average of 15.7% every year after the midterms. That's what happened in 2019 after the 2018 midterms. So we're going to see what happens. A lot of historical trends are there, but honestly, these historical trends can be broken if like the market decides to crash, and we build out these new models to determine what happens historically now that 2023 becomes one of those defining years for the stock market and the macroeconomy in general. So those are my thoughts. Let me know what you think, bull or bear market going into 2023. Thanks so much for listening and watching. I'll see you in the next one.